Welcome back everyone to the Money Control live stream. You're watching Markets with Santo and CJ. Well, it looks like we're going to have a very strong end to what was a very volatile week, led by, of course, the global markets at this point of time. The Nifty and Sensex looking set to end higher, although we have come off a little bit from the highs of the day, but we are still ending with a lot of strength in the benchmark indices, following a lot of the strong cues from global markets. Apart from that, if you look at global markets, the Asian markets are on fire, European markets on fire, largely led by the bets by traders that the Fed will probably reverse course by the end of this year. Also, news emerging from UK that the UK government may also, roll back some of those, adventurous fiscal planning that they had done. Santo is also providing a lot of relief to the market at this point of time. But I think the only caveat could be the fact that the mid cap and small cap stocks, Santo, are not firing all guns blazing as the way the large caps are, and that probably points to the fact that there could be a lot of short covering that could be driving this market instead of fundamentals.
Well, I don't think there's much of conviction in today's rally. It was
that's a big statement coming from you.
Yes, I mean it's widely at least being spoken about that today's upswing has largely to do with short covering of position. But the fact that so much short covering was short positions were created in the first place seems to indicate that definitely more people seem to be cautious or at least outright bearish in their outlook on the market. So rallies driven by short covering typically, CJ, don't tend to sustain for long, and already we have seen that today itself the Nifty has given up almost half its gains. It's now down almost half from the day's high. It was up close to about 340 points, and at this point it's up about 160 odd points. So it's given up almost half the gains, which means that a lot of long positions which were created this morning, and being the weekend also, it looks like bulls may have decided to trim that, given that near term outlook on the market is still positive. And on the UK part which you mentioned, there's still some bit of confusion whether today is the hard deadline for the BOE ending its bond purchases. Of course, there is speculation about the UK government trying to roll back some of its ambitious plans, but there's still no clarity on that. It's still an uncertain market, CJ, and I would say that it's biased more on the downside than the upside.
Well, Santo, then straight question to you: will this rally sustain till Diwali?
Looks like I would again difficult to hazard a guess, but I would say difficult.
Difficult.
Yes.
Well, before I give my rebuttal to Santo, of course, if you guys have any questions, do put it in the comment section. Use the hashtag AskMC and put in your question, and we will try to take them towards the end of the show. But Santo, Sanjeev Bhasin from IIFL Securities, you know him pretty well, I'm sure. He was so bullish today. He suggests that 18,200 is where the market will end on Diwali day, basically the Mohra trading day, and he's expecting the mother of all rallies in the second half of October. Largely, probably, my guess is that he's betting that if the global situation turns in the favor of the bull, the bears will have to cover their shorts like anything. It would be Hail Mary on the shorts that have been created, and we know that FIIs are sitting on a lot of short positions at this point of time in the market, and therefore I think there is good merit to the argument. Whether that will turn out to be right or wrong, we will have to wait and see. But it seems to me, Santo, that market, with every negative data that is coming on the economic front, the market is becoming even more bullish that the Fed will have to reverse course, and when the Fed reverses course, it will be good for the market. So bad news would eventually become good news from a stock market point of view. But also, I think this reversal of UK government's position, which almost created a scare in global markets, almost 2 weeks ago, I think that is also easing a lot of the financial stability risk that a lot of people were, getting concerned about, especially all those hedge funds and pension funds who were sitting on a lot of leverage on high level of debt. There was fear of almost as many of them going, belly up. So with that fear also reducing, with every trading session, that is also providing a lot of comfort and confidence to the market. And that is probably one of the reasons I feel that we could be touching towards the 18,000 mark. Not so sure that 18,200 is the specific level, but I think we should be touching closer to the 18,000 mark on, Mohra trading day, that is on Diwali day.
Still a trader's market is how I would say it, CJ. Since March, the market has been making lower highs. That is something that's a little
but the most interesting part is, Santo, that in this recent correction, we have not just gone one way down the hill. We have been able to sustain ourselves around that 16,800, 17,000 mark, and clearly it seems like that is the very strong support that the market has at this point of time. And as long as that holds, and maybe we can breach the 17,495, which is the 50-day DMA, then bulls will really, start, playing their bazookas and their drums and whatnot once Diwali is around.
Well, I would say that the bounce back that you're seeing largely has to do with buying from a lot of people who have not seen a long bear market.
Possibly, that is possible, but hopefully we don't have to see one. Who knows?
Who knows? Well, CJ. And with that, let's take a look at the stocks on our watch list this afternoon, starting with Computer Age Management System. Now, CJ, as far as the fundamental side of the story goes, it's pretty much strong for, it's a direct play on the growing interest in mutual fund. We've seen more money coming into mutual funds. Also, it's a near duopoly situation as far as the registrar and share transfer agent segment is concerned. Now, CAMS has almost a 70% market share, and it's the undisputed leader at this point in time. Also, is well entrenched with about 10 of the 15 top asset management companies in the industry. Now, the thing about this business is that it's very sticky. Once AMC signs up with a RTA, then it's a lot of hassle to actually move, shift business elsewhere. So, it's quite a sticky business in that sense, and that is what gives CAMS its main strength. Besides that, other than the mutual fund side of the business, where it is pretty much strong, it's also got a fairly good presence in the alternative investment fund as well as the PMS segments. Besides that, the IRDA directive recently that insurance companies should
also have
they should look at dematerializing their policies. That is also going to be a big kicker. Of course, there is competition for CAMS here because NSDL, CDSL too will be in the same segment. But that said, the market there is still pretty vast. If you look at the fact that the insurance segment is still quite underpenetrated in the country. Motilal Oswal is among the brokerages which is very bullish on the stock and has a price target of 3,000 rupees for CAMS.
Well, Santo, I think it's hard to argue from a longer term perspective at this point of time on CAMS, given that financialization has been a theme that has been ongoing in India for the past 6 years now. But I think the only chink in the armor could be the market volatility, and here I'm going to rely on your point, that you have made time and again against brokerage businesses. CAMS also is related to the stock market, and of course, recently we have seen that equity inflows to mutual funds have started to dry up a little bit, probably driven by the sort of meager or non-existent return that the market is seeing over the past 6 to 7 months. And I think therefore the only risk to the MF business could stem from there. But yes, there are good growth opportunities that CAMS is trying to get into, especially trying to be a share registrar for the PMS space, which is really up and coming at this point of time. Apart from that, if you look at it from a technical point of view, for a short-term trader, if you're a short-term trader, clearly I think the charts are looking a little neutral to me at this point of time. Some of the momentum indicators are either on the overbought section or are toward, leaning towards, towards the oversold area at this point of time. So I think the stock is lacking a little bit of momentum, maybe from the near term, and therefore it is possible that this stock could consolidate till there is a clearer picture that retail inflows are again coming back, mutual fund inflows are again coming back, and that could be the next kicker for the stock going ahead.
Just one point on that comparison you made with broking and mutual fund industry. Here, when you look at MF inflows, they tend to be a little more sticky because more money is now coming in through the SIP route.
True.
It's the momentum and the lump sum investments which are seeing a bit of volatility. As far as the SIP goes, that number has been steadily increasing, and also if you look at the numbers for September, the average ticket size has come down a little bit, which indicates that more newer player, smaller ticket size means that newer players are also getting into the, more investors are getting into the fray. So at least the outlook as far as SIPs goes is pretty much robust for a RTA player like CAMS.
True, Santo. That said, let's move on to the second stock on our radar today, and this is TNPL. Well, TNPL, I mean, a lot of you guys may not know about this company, and frankly, even a week or so ago, I was also not aware of it. But it's an interesting story that is developing in the small cap space at this point of time. It's the third largest packaging, board manufacturer in India, just behind ITC and JK Paper right now. And if you look at, what the company is trying to do, it has realized that, of course, its cost structure is haywire, Santo, especially in the inflationary period over the past 1.5 years. It has realized that it needs to take a lot of urgent steps to improve the cost structure of the company, and therein I think lies the opportunities for longer term investors out there. The company has taken a lot of initiative recently. A major part of that is the new pulp, wood pulp mill that is coming up, that is going to increase the share of low-cost wood pulp to almost 60% from 25%. So that itself automatically gives you a lot of beta as far as the margin improvement is concerned, Santo. Apart from that, Sunidhi Securities believes that going ahead, because of the increasing use of wood pulp in board manufacturing, furniture board manufacturing, this could result in premium pricing for a company like TNPL, and therefore the realization as well as margins of TNPL could be on an upward or an upswing in the coming quarters going ahead. Apart from that, from a valuation perspective, something that you always keep an hawk-eye on, Santo, if you look at the valuation at this point of time, and I'll rely on a valuation metric that you tend to also rely on a lot, that is the EV upon EBITDA, which is basically enterprise value divided by your operating profit. Currently, the stock is available at almost 2 times FY25. This is forward, almost 2 years forward, EV upon EBITDA of 2 times, which is extremely attractive for a company that seems to be on a turnaround journey.
Well, there's been definitely an improvement of late, at least the stock price seems to be reflecting that. My only slight worry here is that stocks like TNPL, which is where the business is slightly cyclical in nature, given the sharp fluctuation in pulp prices, one needs to be a little careful, because 5 years back the stock was the toast of the market, toast as in the positive sense, not the negative sense.
Okay.
It had run up quite a bit, around 483 was the peak at that time.
Yeah.
Then even before the earnings had peaked, the stock then came up very sharply, and still it's nowhere close to its high. And even in terms of earnings, if you look at it, the earnings, both top line growth as well as the earnings, they are still a far cry from the kind of numbers that the company used to post earlier. I mean, this could probably change going forward. I'm not saying it won't, but these are some of the red flags that I see in the company at this
I think, Santo, if you look at some of the commentary that has been coming from on the demand side from the one of the industry leaders, which is JK Paper, I think if you take that and extrapolate it to probably the third largest player, I think therefore on the demand side, I think the cause for concern is very, very limited. The only problem for TNPL was that on the cost side, it was lagging behind peers like ITC or JK Paper, because they were 100% integrated manufacturing lines, whereas TNPL was only 70%. So with the new mill coming up, that percentage will go upwards to 95-100%. I think with the cost benefits coming in from the reduction plan, therefore you could start seeing improvement in profitability and margins that could inch higher towards the level that JK Paper is posting. And I think that is the only play. It could be a tactical play of 1 to 2 years, 3 years, but that is something to watch out for, Santo, going ahead.
Well, next stock, Hawkins Cookers. Again, in an uncertain market, the defensive plays always make good bets, and Hawkins Cooker is one of them. So, second largest player in the pressure cooker manufacturing segment, with almost a 30% market share, and this company has been a consistent performer. If you look at the growth in top line as well as earning, nothing flamboyant about it, but it's been steadily inching up. This is also among one of the recommendations of Money Control Pro. It's reported about a 14% increase in top line over the last 5 years and a 16% growth in bottom line. Besides that, aluminium prices, the easing of aluminium prices from the highs of March that you saw, that is clearly going to help improve the margins of Hawkins Cookers. And a fundamental trigger for the stock is that as there is more LPG connections in rural households, you will see greater demand for pressure cooker, and given the brand name that Hawkins Cookers has, clearly it should benefit from such a trend, and also valuations are pretty reasonable at this point in time.
No, Santo, I think markets are no fun if they are not flamboyant, and therefore a stock like Hawkins, yes, it may give you that average 5 to 10% return CAGR every year, but I think if you're looking for growth stories, I think you will have to look beyond Hawkins at this point of time. At best, for me, it is a tactical bet on the festive demand, that you can currently see. But if you look at the longer term trajectory, yes, maybe LPG connections could provide a good trigger for demand, but that also has a saturation level, because you can only have so many LPG connections in the country. Apart from that, the return to office, of course, will reduce the dependence on a lot of individual on home-based cooking, and you will see a lot of eating out, and therefore the demand for utensils that Hawkins sells may taper off after the pent-up demand that it has seen during the COVID time. So that is another issue that I would want to point out, and please make a point before I move on to my last point.
So the point is that a counter argument to that is because of rising food prices, right? the more people could be tempted to then start cooking at home to save on cost.
Well, Santo, I will rebut that point in my next stock pick. But last point, of course, is the fact that if you look at Hawkins' margin profile, Santo, over the past few quarters, I think I noticed that there has been a weakening of margin profile as well for Hawkins, and that could be, of course, attributed to the rise in raw material prices that we are seeing. But it could also be a signal that competitive pressure is also quite high in the sector, and therefore the company's revenue growth maybe is coming at lower and lower level of profitability. Well, Santo, the next talk, and coming back to your point, whether people want to eat in or eat out, Westlife Development. Well, this is another stock that has been reaping strong gains because of the change in sentiment towards the QSR segment. Back in March, everybody, when the inflation bandwagon was going all guns blazing, everybody was worried that will people step out, will they want to eat out, and those sort of concerns were there given that inflation was pinching pockets. But clearly, if you look at the Q1 earnings and if you look at the Q2 updates, clearly demand is still very, very strong. People are shopping, people are eating outside, people are trying to get more, what they call a dine-in experience that they could not have for the past 2 years. And therefore, it is very, very, pertinent that a company like Westlife Development could do quite well going ahead. Apart from that, if you look at on the margin side, the fall in raw material prices sequentially is likely to aid margins of the company in the second half, basically, which is Q3 and Q4 of FY23. And one of the crucial things about Westlife, Santo, is the fact that they have been very innovative in their product offerings in the market that they exist in. You talk about meal combinations, you talk about value packs. They have been able to bring such combinations into the onto the shop floor, and they have largely taken off with the customers, and I think that is where the company stands to have an edge over some of its competitors in the QSR space. And lastly, Axis Securities, of course, which has named Westlife Development as one of its pick for the next 1 year. They believe that the stock could have as much as 22% upside going ahead.
Well, hard to argue against a stock that's been doing so well, and also at a time when most people thought that rising inflation would hurt companies like this. But that said, while the revenue growth has been good and the company has been able to maintain its margins, the profitability is still nowhere near what can possibly justify this kind of a high valuation. To some extent, then it becomes a theme stock. The borrowings of the company has risen very sharply over the last 4 years. It's almost increased fourfold. So till the company manages to earn sufficient revenues, probably servicing that kind of debt is going to be little difficult. And if you're okay paying very high valuations, like something like 200 times trailing 12 months, then it's fine. It's a good stock, not a problem. But those who are more finicky about profitability, which it's not always the best measure for every stock. There are stocks which do well even if profitability is not there. But if you are finicky about that, then maybe this is not the stock for you.
Well, Santo, valuations can always be debated, but I think given the growth prospects that Westlife Development is providing at this point of time, maybe investors would be comfortable paying those valuations.
Maybe. Well, last stock, Federal Bank, a strong set of numbers here, and they're much better than what market had expected. This can be seen from the fact that the stock is up 5% after Federal Bank reported its earnings. There's an all-round improvement. It's all about numbers more than anything else. Now, 703 crore rupees of profit for the quarter, while the market was expecting about 637. So there's a wide beat there. Gross NPA has come down to 2.46 from 2.7%. Besides that, loan growth at 20%. There's also an improvement in net interest margin, improvement in slippages, and also recoveries and upgrades to have been higher. So all round, the stock is firing on all cylinders. The management has also said that revenue growth was broad-based across all its segments.
Well, Santo, clearly you can't argue against numbers like those, but I just feel that maybe from a short-term perspective, there is a case to be made for a correction in Federal Bank, given the fact that the stock has really seen a one-way rally over the past year and a half, and largely because of numbers like these that it has been reporting for quite some quarters now. It's not just been a 1 quarter or 2 quarter phenomena. It's been multiple quarters that Federal Bank has been reporting improvement in its metrics. If you look at some of the momentum indicators, some of those momentum indicators are now teetering towards the overbought zone, and I think that is why I feel that there could be a possibility of some profit booking in the stock after the earnings, this earnings rally is through. And the only thing going forward, Santo, that investors who want to focus on is the fact that yes, the company has reported about 20% year-on-year growth in its credit offtake, but will that sustain? Will that number sustain when everybody in the sector is getting so aggressive on loan growth? I think that is something to watch out for, because now it is going to be relative comparison. It's not going to be an absolute number that will make investors happy. Investors are now going to compare every bank against each other, pit them against each other, and see which one is going to stand out in the second leg of the credit offtake cycle that we are seeing in India. And therefore, I think the sustainability of the gains in the stock will be quite closely linked to the sustainability of loan growth.
Well, you know, CJ, it's interesting, although at this point in time the fundamental picture looks quite good. Again, someone who's been holding Federal Bank for, let's say, 10 years is not going to be very happy. The stock had previously peaked out at around 120 odd, and it's after a long time that the stock has again gone past that level. So someone who had probably picked up during the height of the COVID panic, when it had fallen below 40 rupees, or I think it had fallen somewhere around 40 rupees. For him, it's a three-bagger. But for the long-term investor, right? So it's very strange, you know, how the market.
It's funny, Santo, because you being a long-term investor, I mean, if you had held on to Federal Bank, you would have definitely made my case that probably it is not that big a bet to
you know,
make.
the most new investors, right, they are looking at the market only from a 2 to 3 year window, and when share prices are rising, at that point it looks like this will continue forever. But it's only when you track it over long periods, you know that something that looks very good for 2 or 3 years suddenly may not. Prices can remain stagnant for 5, 6, 7 years, right?
That is true, and I think that is the game, that is stock market, that we all love and, you know, track every day. That's it, Santo. Before we move on to the market update, you know, one of our viewers, Aarti R, wants our thoughts on IndusInd Bank for the short term. The stock has taken a pounding over the past few sessions, and it seems that it's been largely on the back of some profit booking that has emerged after a very, very strong second quarter for the company overall in terms of stock performance. So going ahead, what do you think?
Well, Aarti, CJ is the guy who's always been batting for IndusInd Bank, so I will let him take the first shot.
Well, Santo, I think this is, if you look at it from a fundamental perspective, IndusInd Bank is likely to report a very, very strong quarter, Santo, for the second quarter running. The company's asset quality has been improving for a couple of quarters now. Loan growth has also been edging closer towards the mark that, say, a lender like HDFC Bank or an ICICI Bank has been reporting. So clearly, there is cause for optimism as far as fundamentals are concerned. But when you are in a long-term rally, as IndusInd Bank seems to be in since last November, I think these bouts of corrections can usually be seen as an opportunity to dip your feet into the stock, because I don't think fundamentally there is anything to, you know, raise any sort of concerns as far as stock price performance is concerned.
Well, I'll largely agree with what CJ has said. There was some perception problem with IndusInd Bank till some time back. I think those concerns are gradually fading now that there's been a visible improvement in asset quality. So at this point in time, yes, whether the re-rating is underway or not, that's some kind of a question, because we are still seeing a lot of volatility there. But the situation does not seem as dire as it was till, let's say, about a couple of years back.
Absolutely, Santo, and I think a lot has to be done. A lot has to do with the fact that the real estate cycle, which was also a big part of the company's book, that has improved. The lender is now focusing more on the retail side of his business. That is also,
and the CV cycle is also improved.
And yes, the automobile cycle is also in favor of IndusInd Bank as far as loan growth is concerned. So the three major factors are working in its favor, and therefore this is a stock to watch out for, in my opinion.
Well, and with that, a quick take on the markets.
We are holding on. I think, Santo, we are holding on to the day's gains. I think from the moment we started the day, started the show, I think we have held on to the gains, and it looks like we are going to end higher by at least a percentage.
Mid-cap has though slipped.
Yes, but mid-cap index, that is the one that is, and as I said in the beginning of the show, the mid-cap index looked like a big concern to me, because it seems like there is not enough conviction at this point of time in the middle small cap indices, and you can see that the small cap index is also now edging towards, you know, the flatline mark. So clearly, from being almost a percentage higher at the beginning of the day, now both of those indices are looking to end the day probably in the red territory.
And what are the things that we need to keep an eye out for? It is earnings season, so which are the big ones that we should
Well, Santo, tomorrow, of course, although the market will not be open, but HDFC Bank and DMart will be reporting their second quarter earnings, so that is something to watch out for. Apart from that, next week is very, very heavy on earnings, and, you know, large Nifty company earnings, including HUL, ITC and ICICI Bank. So watch out for those. Apart from that, of course, what is happening in UK, I think everybody ought to keep an eye out, one eye out on UK in terms of the possible rollback of the fiscal plan that the new government there, or the new Prime Minister and the new Finance Minister, they had proposed not so long ago, which had created almost a meltdown situation in the global market. So that is something to keep your eyes out on.
Well, and with that, it's a wrap on this edition of Markets with Santo and CJ. I hope you enjoyed watching it, and please do remember to post your feedback in the comment section below, and have a wonderful weekend.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live Monday morning. Till then, have a great weekend.
Watching, not a bad number, yeah?
Yeah, started off 14,000, I think. We can't move out yet. Mike,
I'm the one who's not. No. I said I'm the one who didn't take off the mic. He's the one who's in a hurry. I'm pretty much seated here.